we're looking at a market that has been supremely underestimating the potential for all-out war in the Middle East. We are now coming up on the one-year anniversary since Iran, via its proxies, Hamas, Hezbollah, and the Houthis, declared war on Israel specifically and the West in general. Now, we saw a spike in implied volatility this time last year in October when the war began. But volatility was halved from about over 40%, and it lulled in around 20% back in July. This is clearly the market not pricing in a risk premium. So all year long, the market has underestimated the volatility and have refused to price in a risk premium. Now, since about the third week of September, that risk premium has increased. Volatility has increased, implied volatility is increased by about 50%. But still, we're looking at a situation here in the Middle East where war is hotter than ever, and oil just continues to trade on a headline like it did today, but we are well off the highs. So clearly, traders are still taking a look-see that things will quickly resolve. I'm not in agreement with that, but I have to respect what the market action is right now.
Talk a little bit about market positioning heading into today's attacks. There was a lot of bearish bets, and as a result, we did see that pop, perhaps a short squeeze. But I'm wondering where that leaves us now in terms of positioning.
Yeah, absolutely. We've been since about the past 3 months, especially in the ICE Brent crude oil market, which is your benchmark for the global oil market. Hedge funds bet massively wrong at the beginning of the summer. They were extremely long, and they've been exercised out. So you have a lot of money that has been lost or money that has moved to the sidelines. So there still is plenty of ammunition, money to throw at the market should we see any significant disruption. And this is the key. It's a disruption to oil. And this is also the conundrum, because we now have vessels, oil vessels, that have to avoid the Red Sea, that have to go through longer transit routes because of the Houthi attack on shipments in that area. And yet, despite that disruption to supply, markets refuse to react. So the market is going to continue to trade on the headlines regardless of the positions. But we have to keep in mind we must see a disruption in the flow of oil, which we have yet to see. So the market's reaction today, spiking on that original headline of the missile attack, but now quickly pulling back. Unless we see a disruption in the price, this will be an opportunity for speculators to sell into, because the game plan has been over the past year, it's buy into the rumor and sell the fact. The old adage on Wall Street, right?